Hey everyone, it's Kirk here again at Option Alpha. So in this video, we're going to go through debit spreads versus credit spreads. This is going to be a fun one because we're going to go through not only just what the differences are and how you can set up these different types of trades with lots of examples, but I'm also going to show you what I do to find different types of trades, whether I'm looking for a debit spread trade or credit spread trade. Typically credit spread trade, just so you know. So we're going to go through that all in this video. So first, debit spreads versus credit spreads. What's the difference? Honestly, it really boils down to one simple thing. Like if we could just broadly say, like, what is the main difference here? I know there's a lot of nuance in here, which we'll get into, but the main difference is, did you collect money, i.e. you have a credit when you enter the trade, or did you pay money, i.e. you paid a debit to enter the trade? That's really the main difference. So debit spreads are when you pay money after all the buying and selling of option contracts, which we'll show you. Debit spreads, you pay money to enter the trade. Credit spreads, you collect money to enter the trade. So you could also say this is the difference between net buying options and net selling options. Debit spreads, you are net buying options. Credit spreads, you are net selling options. So a credit spread, like we said, is an option strategy that involves selling one option and buying an option further out of the money, typically for a net credit overall. That means you're going to buy an option contract and sell an option contract, but the differences between those is that you're going to collect money for a net credit overall. You're going to get paid to enter the position. A debit spread, on the other hand, is essentially the opposite. You're going to be buying an option contract, selling another option contract at a strike price further out for a net debit overall. So it's still going to cost you money to enter the position. So this is that difference between net buying and net selling. Now, you're probably thinking at this point, should I be net selling options, net buying options? Should I use debit spreads versus credit spreads? Of course, there's no perfect correct answer for this. It depends on the strategy you're running and the market that you're trading and the technicals you use or all the different setups that you could possibly use. But generally speaking, because we track this across the entire Option Alpha platform, and of course, this is all live trades across the Option Alpha platform, we can actually categorize this into different types of spreads that people are using and the overall win rates. Again, this is very broad because, of course, people have different profit targets and stop losses, etc. So we can't get so minute into the details, but broadly speaking, if you look at these types of trades, which these two right here, which would be long call spreads and long put spreads, these are debit types of trades. These are debit spreads. So we'll just put a D right there for debit spreads. But you can see that the win rates are not too great. And this would be generally what you might expect for a debit spread most of the time, because you're net buying options, you're not necessarily taking advantage of volatility. And if you're buying these, you definitely want to buy these types of spreads, go a long call spread or a long put spread. You definitely want to do it when volatility is really low, because high volatility can hurt these strategies. If high volatility is present, you pay for it and then it drops. Again, we'll get into all this in the video here too. The opposite side of this is the net credit spreads. These would be these two types of strategies here, again, broadly across the platform. Again, not accounting for all the different profit targets and stop losses that people use. People are generally having success as far as win rates go for these types of trades, because usually credit spreads are entered out of the money, which means they typically have higher probabilities of success to begin with. Again, we'll show you how you can find these types of trades in this video. But if you're just asking yourself right at the beginning here, do I want to do debit spreads or credit spreads? You probably tend to want to lean towards doing credit spreads. All right, so let's get back into the slides here and go through these. So vertical spreads. So let's just get the basics out of the way. So debit spreads and credit spreads, they're all in this family called vertical spreads. And the reason I introduce this now is because you might hear this terminology if you're out there in different trading communities or different forums or whatever. You'll hear people say enter vertical spreads or trade vertical spreads. Basically, it's exactly the same. So vertical spread just involves buying and selling option contracts of different strikes in the same expirations. So they got to be calls or puts, but they must be the same type. And the reason it gets this name is because you can visually see this on the option chain. So typically, if you're looking at an option chain, you're going to visually see it vertically up and down, that you buy this one and sell that one. So inside of Option Alpha, this is exactly how it works. So if you go into Option Alpha and you're starting to build a trade, you'll see an option chain like this, like a call side of an option chain, and you might choose to buy the 605 and sell the 610, or you might choose another combination. But you can see visually here That's the vertical nature of it, because you can vertically see how you're moving and buying one contract and selling another contract up and down the chain. All right, so let's go into an example here. So the first one we'll go through is a long call spread. This is also known as a bull call spread or call debit spread. Again, they get all sorts of names. You can even a bull call vertical spread or vertical call debit spread. I mean, there's so many different ways. It's all the same thing, okay? So all you're doing here is you have a long call spread created when you buy a call option and then sell a higher strike call option with the same expiration date. So you're going to buy a call option, then you're going to sell a call option at a higher strike price with the same expiration date. These long call spreads are open for a net debit, i.e. you still pay money after all the buying and selling that happens, because it's a long call spread. It's a debit spread. It means that if you buy one and sell the other one, the difference between those is you're still outlaying money. But it's a bullish strategy, and that's why people like to trade it, because it reduces the cost of owning just a long call outright. A long call might be really expensive. So what people do is they sell another call option higher above that to kind of finance part of the purchase price of that call option. So they still get that bullish exposure, but it's not as costly as outright buying a long call. And again, we'll go through an example here so you guys see it. So here's what a long call spread or a bull call spread looks like. And what you're generally going to be doing, again, is you're going to be buying an option, a strike, a call option at some strike price. In this case, the example here is $50. That's the strike of your long call option. So that's where you get this first pivot here in this payoff diagram. This is kind of the long call option portion of your payoff diagram. And then what you're going to do is you're going to go out and sell a call option at a different strike. In this case, you're going to sell it at, say, $55. And this is what creates the spread. This is the debit spread that you have. Now, the difference between buying the 50 strike and then selling the 55 strike is it still costs money. It still costs money to enter the trade. But what you get in this case is you get a reduced overall cost to enter the position, right? And in exchange for that, you've capped your upside potential. So that's the give and the take. And that's really important because all strategies have a give and a take. And if you're going to enter a spread, the general give and take is that it's going to cost you less money to enter the spread than a general long call option, but you're going to give up some of your upside potential. So you can't get anything for free. There's no free lunch here, right? So what ends up happening is that when you enter this type of position, you generally have this type of payoff or expected outcome in the market. And I like to show it visually like this when I do training and videos like this, because it just makes sense visually for me. And like, I'm more of a visual person up and down here, but you can see it different ways. But generally what you're doing again is you're buying a call option at 50. So in this case, remember you bought this 50 call option, right? That's kind of your floor, if you will. And then you sold this 55 strike call option. And so what you're doing is you're essentially giving up any additional profit potential above this level. Above this level, your max profit the whole time. There's no extra profit that you make in this case, right? And so you have some variable profits, some variable losses around your break-even price. Let's say the net difference between buying the 50 and selling the 55 was $2. So your break-even is about $52, right? So now what happens is that if the stock starts moving, and you can see it here moving, my super awesome graphics, right? The stock starts moving up, you get into variable profits. If it comes back down, you get into variable losses, et cetera, right? So wherever the stock moves by expiration, that's what your ultimate profit and loss is going to be. It's a risk-defined strategy. That's why people like to do it, because you have to find risk, you have to find profit, and it usually doesn't cost a lot of money to do it, okay? So let's get into an example here so we can show you how this works. We'll just build one out here inside of one of my bots that I have on Option Alpha. So we'll use SPY, we'll go down to a long call spread, and then we'll just choose an expiration. We'll just choose the next monthly expiration. So what we're going to do to build out this long call spread, this debit spread, if you will, is we're going to choose first our long call strike. Now remember, this is the option chain here. And typically what you do is you buy an option, usually, sometimes it depends, different strategies, but sometimes in the money or at the money, etc. We'll just buy one here at, let's say, 610. So we'll buy the 610, we'll go long the 610, and then immediately we know that we need to select our short call leg of our long call spread. Now, this is where you are going to sell an option contract further out. Now, remember, if we were to outright buy a long call option right here at 610, it would cost us $900. So $9.07, but you convert over, it's about $900 just for a long call option. This is the benefit of doing a spread, is that you can essentially reduce that cost of doing the long call option by selling a call at a higher strike. And so what you would do in this case is you would come in here and you would say, okay, I want to sell, let's say the 615 call option for $620, $30. That reduces the overall cost of my long call spread. When you do that in Option Alpha, it builds the payoff diagram for you so you can see what that position looks like. And you have in here all the critical information. So just like we showed you on that payoff diagram before, this is your long option that you're buying. You're buying the 610 strike option, and then you're selling the 615. This is where your payoff diagram pivots at these 2 points. And then your break-even price is the price at which you pay, so your mid price essentially plus your long strike. This is your mid price, their break-even price that you have to get to make this strategy profitable. But notice what we're doing here is we're reducing the overall cost by reducing our upside potential. So anything above $615, if SPY goes crazy from here and goes above 615, we make our full profit. In this case, the full profit would be $221. It's kind of moving around with our pricing here, but we don't make anything else. And that's okay. Maybe that's the trade-off that we want to make, is that we want to make this trade-off where it's less money to get in, so it doesn't cost us $900 to get into this 610 long call. Instead, it costs us roughly $270. That $270 is our max loss also. So this is the benefit of doing a call debit spread or a long call spread. Lower overall cost to get into the position, lower potential profit, but the cost is also lower and you can get into the position instead of doing it really, really expensive. Now, as always, you can kind of mess around with this here and play around with different strikes if you want to kind of move things around and see how that changes your probabilities and your potential payoffs. This is all things you can do inside of here, and you can, again, of course, mess around with this as much as possible. Now, I'll show you here in a little bit how you can automatically find different types of trades without having to mess around with this in here, but I'm just showing you can do that inside of Option Alpha if you choose, okay? All right, so let's get back over to the slides here. Let's go through the next example. The last one that we went through was a long call spread. That was a bullish strategy. This is the exact opposite. So this is a long put spread, aka or also known as a bear put spread or a put debit spread. This is still a net buying strategy, but what you're doing is you're entering a debit spread where you're buying options on the put side versus the call side. So this is typically created when you buy a put option and then sell a lower strike put option with the same expiration. You're still doing it for a net debit, which means you pay money to enter the trade, but just like the other example, the reason that you would do this is because a long put option is very expensive also, so you would finance and kind of choose to offset that cost by selling a put option at a lower strike, reducing your overall profit potential or kind of capping it, but the overall cost to enter the trade is much less. So in this example here, what you would generally do, again, kind of same setup, you would buy the 50 strike put option. That might be some value. And then you would sell the 45 strike put option here. That creates the inverse payoff diagram from the long puts or long call spread that we saw. And let's say that that net cost was $1. So you reduce your break even down here to $49, just the $1 difference between the long put option that you bought and the net cost. And so what you have is you have this payoff diagram where, again, you have capped risk. If the stock continues to move higher, you're still capped at only losing the amount that you paid to get into the strategy, but you also have max profit being capped as well. So that's the trade-off. Lower cost to get into it, of course, than just outright buying a long put option, but you also have reduced profit potential. So if you look at this visually on a chart, it would look something like this. This would be the inverse of the one we saw above, where let's say you think the stock is going to go down. You don't want to buy a put option outright. You want to kind of finance it. So you buy the 50 strike, you sell the 45 strike. And now if the stock does continue to move lower, you make, the money here and your profit is capped, okay? Let's go back over here to Option Alpha. Let's choose a different example here. Let's go back to a long put spread this time. We'll use the same expiration. And now what we're going to do is we're going to select first. Let's select the long put leg first. So again, what we're doing here by selecting the long put leg is assuming we want to enter a position that gives us bullish or bearish exposure on the S&P. We think it's going down or whatever our assumption is. Technicals are telling it, whatever it is. So if we wanted to buy a put option outright on the S&P right now, like the 612 put option, which is slightly in the money, it would cost us $780 to buy the 612 put option. So we don't want to do that outright. I mean, you could if you want to, but it's really expensive. So what we're going to do is we're going to buy the 612, and then we're going to go here and we're going to sell a put option at a lower strike to help finance that cost. And if we can sell this put option, let's say the 607 put option for $589, $587, that reduces the overall cost on this trade down to around $200, $196 and kind of moving. Now you can see this is the new payoff diagram for this one. And it looks just like what we had shown you in the example where your long put option is this strike right here. That's your long put option that you bought. And then you got your short put option at 607. That's this one here. This is where you can see your max risk is, or your max profit potential was capped. So anything below 607 is just max profit. That's it. You don't make anything extra because you chose to cap your max profit by selling the 607 and reducing the overall cost to get into the trade. Now, this particular trade right here has risk of about $200. That's the cost of getting into it. So that's the benefit. And the potential reward is about $300. Depends on the setup right now, but looks like it's okay probability of profit, about 50-50, decent risk to reward. But again, you can kind of mess around with this and you can see, do I want to enter different types of positions? Do I want to spread this thing out a little bit more and see what the different variables are and costs are to get into the trade? All right, so now that we've done that though, it's usually not that beneficial to come in here and play around with different types of strike prices and expirations, let alone trying to figure out what symbols to actually trade. So there's a better way to find this. And what I do is I go into something that we call trade ideas. And so inside trade ideas, it's a different way of finding trades than maybe you're typically used to doing if you're not inside of Option Alpha. So if you're a regular trader right now, normal trader, you probably go into an option chain and kind of look around at different pricing. You're investigating manually all the different prices, but it's hard to keep up with that. So what Trade Ideas does is it automatically analyzes hundreds of millions of different combinations of spreads throughout the day. And it just presents those into more of a shopping list format. So in this case, the first thing we can do inside of Trade Ideas is simply click on debit spreads. And if I click on debit spreads here, what it does is it filters the list I see of all potential trade ideas to only analyzing lots and lots of combinations of debit spreads. And from here, rather than randomly picking and choosing strikes, I can set my criteria that I want for a particular type of trade and then allow Trade Ideas to kind of surface those available trades, and I can pick from those. So let's say, for example, I want debit spreads with a probability of profit, let's say 55% or higher. And let's say I want bullish positions that are debit spreads and only ETFs, right? So now what I'm doing is I'm taking the whole universe of all ideas that are inside of the platform, and I'm filtering those for debit spreads that are ETFs, only bullish positions, which would be long call spreads, and those positions with a probability of profit higher than 55%. So from here, I have a really targeted list that I can work from, and I can say, go through this list and sort or rank anything else that I want to, but let's just look at this top trade idea right here, which is the 30-31 long call spread in FXI. And you can see this one is not a bad trade. maybe a trade that you might be willing to make. You just find a trade in here that is a trade that fits your criteria, and then you can make that trade, place that trade right inside of your bot, okay? So I'm not gonna make a debit spread trade right now. We'll make a credit spread trade towards the end of this video. But again, you can see how you can surface some of these ideas rather than just kind of picking and choosing randomly. Of course, if you like any particular symbol, you can say, okay, only include SPY. And this is actually pretty fascinating. Like the only trade right now idea here is this SPY position. Maybe you want more, so you say, okay, look, I'm open to trading other debit spread types of trades. You can also flip this over and go with bearish positions. This would be long put spreads, so maybe there's some other opportunities that are long put spreads right now in different ticker symbols. Again, you can kind of filter and sort this to make it be whatever you want to be as far as surfacing trade ideas. All right, so let's get back to the slides here. Let's switch over and change gears and look at now credit spreads. So all we've done so far is look at debit spreads. These are net buying strategies. Now let's switch gears here and look at credit spreads. I like doing credit spreads personally. And like we showed you earlier, credit spreads generally have better metrics and setups than debit spreads if you use them wisely in your trading. First one that we'll look at here is a short put spread. This is also known as a bull put spread or a put credit spread. So it's a short put spread where you sell a put option and then you buy a put option at a lower strike of the same expiration. Now, the goal in doing this is you are going to be a net option seller, which means that you get paid money, you get a credit for entering this type of position. And the goal generally with put credit spreads is you're going to sell them out of the money. So you're going to force the market to kind of turn against you and go completely against where you're selling these strikes. This allows the position to potentially profit if the market stays the same, goes higher, or even goes lower. As long as it stays above your short strike, you can generally make money with this strategy. So again, it's a bullish strategy, but you're net option selling, which means you're collecting money, hopefully playing the right side of implied volatility. So how does it work? Well, it works basically in the inverse of the other examples that we showed you. So in this case, you would have a 50 strike put option. You would first sell that 50 strike put option, and then you would go down and buy the 45 strike put option lower. And then you would take in a net credit. In this case, the net credit might be $1, $100 of premium. That would be your max profit. So your goal is that the option contracts expire worthless, or the stock continues to move higher or sideways, and you keep the whole premium. Now, the benefit of doing a spread is that if you were to do just the regular short put option at 50, you would have unlimited risk. So if the stock continued to move lower, you have to put up a lot of margin. If the stock overnight crashed or gapped lower, you have unlimited risk. So what you're doing here is you're actually choosing to cap your downside risk by buying an option contract further out at 45. This is a smart strategy. It's a very good strategy for newbies because you have defined risk and defined profit. It means we can calculate lots of probabilities and stats around that. And there's not that unknown, like can't sleep factor of if the stock just absolutely tanks or craters or the market just gets destroyed, then this potential position could balloon in loss. So what it looks like when you look at it visually on an option diagram or like a chart, and I visually see it like this, is you basically have this opportunity here where if the stock stays above your break-even point, then you've got some variable profits, some max profits, and if it goes below your break-even, this is where you start to induce that loss. So your goal is that if you are entering this position, you want the stock to stay the same, trade sideways. It can even trade a little bit lower, but it really can't go below your strikes that you have here. So in this case, you don't want it to go significantly lower than your 45 strike. You definitely don't want it to go lower than your 50 if you can help it. That's your max profit zone. So if you enter this position and then the stock rallies and continues to stay up, great. That's where you make money on this trade. If the stock turns around and let's say it comes back the other direction, which I don't know if it does in this example, but we can move it down, and it goes back down the other way, then you start to lose money on the trade, okay? So let's jump into Option Alpha. Let's show you how we can get these trades here. So let's go into this one. We'll go into this position here, and we'll open a new position. We'll do SPY again, and this time we'll do a short put spread. We'll just choose those monthly expirations like we did before. And again, what we're going to do is we're going to select the short strike first. This is kind of the first one that you pin down. And if you are going to sell this option contract, It's going to not only bring in a lot of premium, but it's going to have a significant amount of margin that's tied to it. And again, that unlimited risk that we maybe don't want. So let's go here and let's sell the 605 put option. And then what we're going to do is we're going to buy a put option at a lower strike. Let's do the 600 put option to start. So this is what creates our new payoff diagram here for this potential strategy. Again, what you're looking at here is you're selling the 605 put option. That's your short strike. And then you're buying the 600 for protection and to reduce the cost of getting into the position. It fixes the max loss. It's something that we know going into the trade, but at the same time, it also caps our upside profit potential. So our max profit is 131, which is the same as the net credit that we're going to receive on entering the position. So these are interesting trades because generally speaking, if you enter them out of the money, they usually have a good probability of profit, good probability of max profit, but you do want to kind of work around with the different strikes because you want to enter trades that have generally high expected value and high, at least positive alpha versus negative expected value. But again, you can always mess around with the strikes here and see what works for these different types of positions. Now, this is the benefit of using trade ideas, which we'll go back into here in a second, but you can see that it's really hard if you're just kind of picking and choosing the different strikes that you're using to kind of find a trade that works and meets all of your criteria. So it might take a little bit of time. That time is very important to you. It's just better to use a tool that can help surface some of these ideas for you. But you can get kind of the general structure and setup of the trade here. The market's trading at 609 and our break even's at 605. So as long as the market were to stay above 605, if we were to enter a trade like this, then we would make money at expiration. Okay, let's go through another example here and let's look at the opposite side of this. And that would be looking at a short call spread, also known as a bear call spread or a call credit spread. Again, same thing that we're trying to do, just in the opposite direction where we are net selling options and we're doing so on the call side of the option chain. So you're going to sell or short a call option, and then you're going to buy a call option at a higher strike with the same expiration. The difference between those two is still going to be a net credit. You're still going to get paid as an option seller, which means you're going to take in a credit. That's going to be your max potential profit. And you're going to, at the same time, reduce the overall risk on the strategy by capping that upside potential. And definitely want to do this with naked call options. You don't want to sell naked call option because the stock could run away forever and it just creates an unlimited loss scenario. So again, when you're setting these up, you're going to sell a call option. Let's say you sell the 50 strike call, and then you're going to buy some call option higher. That's going to cap your maximum loss so that you don't have that unlimited risk payoff diagram. And in exchange for doing that, it is going to cap your profit here and reduce your potential profit on this strategy. That's okay. That's what we want to do. If it works for your strategy, for your setup, that's what you typically do. That's what I do with my spreads. I definitely do spreads. You can make them wider if you want to. You can make them more narrow. But in either case, probably a good idea is not selling naked call options. So when you look at this one on a chart like this or a visual like this, what you're doing again is you're selling the 50 strike call. You're buying the 55 strike call option. You're hoping that the stock never goes this high, right? And you really want the stock to kind of finish below that level. So when you sell this and the stock starts moving, you want the stock to go down, right? So if the stock goes down, down, great. That's what you want. This is a bearish strategy where you're selling options, collecting a credit, hoping that the market doesn't move against you, or at least there's a high probability that it doesn't move against you, and trying to take the difference. Okay, so let's go back in here to Option Alpha. Let's switch this to a short call spread. We'll use the same expiration here, and we'll first select our short call leg. So again, this would typically be above where the stock is trading. So right now the S&P is trading at 609. So we might sell, let's say, the 615 call option. And then for the long strike, we might go out and, I don't know, let's just try the 620 call option and do that trade. Now, this is an interesting one because, again, what you're doing here is you're selling one option contract, the 615, and then you're buying a further out of the money 620 call option, and that is what is capping this risk. It's really important that it does cap that risk because if you did a naked call option, you'd have unlimited risk. The stock could just run away forever and it could create a cascading effect of loss for one position. So for new traders, this is really, kind of an ideal type of setup because you know your profit and potential loss going into it. You can position size accordingly, and that makes it really easy. So in this case, again, the max potential profit here is the credit that you collect. That's what happens with option selling. The credit that you collect is your max potential profit here. This is what you make if the stock stays below 615. Right now it's at 609.54, which means that the stock could stay the same. It could drop, or the stock could even rally. The market could rally up to 615. You could still make money. As long as it stays below 615, you make your max profit. What I like about this trade compared to the other one, just looking at it, it's got a little bit better probability of profit. It does have a positive expected value and positive alpha. So generally speaking, the metrics are a little bit better for this trade compared to the other trade. This is where you might want to take one type of position over the other. Okay, so speaking of that, let's go back into trade ideas, and now let's start filtering for credit spread trades so that you can look at the differences between those. So again, by default, it's into credit. Like we said, you can choose to flip it over to debit spreads or credit spreads. Here we can look at credit spreads that are, let's say, bearish with ETFs. Let's look at probabilities of profit. Let's go even higher here. Let's say 70% probability of profit. And let's go with expected values that are at least $5 or more. So again, you can do all sorts of filtering in here that you want. And now you get, again, a very, very curated list of potential ideas to start from. You don't have to kind of pick and choose which strikes to go with and kind of, just randomly guess, if you will. You can go in here and say, all right, I'm going to start with these types of trading opportunities here and see if any of these trading opportunities kind of meet my criteria and are good trades. So one thing I like to do generally is I like to filter this list down sometimes. So we'll go out to 20 days I'll go out to 45 days and apply that filter. So that'll take out any shorter duration or super long duration ones. You can filter this list here by symbols if you like different symbols, like we said before. So let's look at this one here. This is this XBI short call spread. Actually, this one's low premium, so we'll go with this next one here. A little bit higher premium here, so we'll surface this trade. You can see this one here is XRT, that's retail. And this one looks like it's an okay trade. It's got a pretty wide spread, so might want to consider doing something a little bit more narrow, or at least trying pricing a couple times. But if we just fixed it here at, let's say a 35 as the price here. If we enter this position for 35 and the market's trading around that right now, what we would be doing is we would be selling the 82 strike call option, that's this one, and we'd be buying the 83 strike call option, that's this one. The net difference between those is a 38, 39. It's kind of moving around as we showed you here. $35-ish, what I just kind of typed in, so it sticks and fixed to the graph here. But that credit. So we might fill 30, 35 or so, depending on what the market's doing at the time. That would be our max profit. Our max loss on this trade would be the difference between the strikes, which is $1, less the premium that we collect. So that's $65. We've got a high probability of profit. This is a positive expected value trade with positive alpha, which is good, which means that if we can get filled for 35, then it's probably a good trading opportunity. Now, we can mess around with this, by the way, and you can mess around with the pricing to see what the impact of pricing will be on your potential expected value, your risk reward, and your alpha. This is all stuff that I actually do once I go in and start investigating a trade idea. So please don't look at trade ideas as something that you just take blindly. You should never blindly take a trade. You should investigate it, see if it kind of fits your criteria for a trade. So let's go over here and try a different one that we can look at. Let's look at something in XLP. So this one's kind of interesting here. This one has maybe a little bit tighter bid-ask spread here. Still has pretty good metrics. The alpha is pretty good. The expected value is pretty good. Hopefully we could get filled at something a little bit more favorable. So if we got filled at, say, something around 34, that probably turns a lot of these numbers more green for us. So you could probably try pricing around 34 or so. Market's somewhere in that range right now. This might be one that you watch and try to get into later on, or send some orders through and try to get into moving forward. So it's really, really fun to kind of go through this and see what trades are out there right now, what trades you can kind of find that meet your criteria. So lots of different trade ideas that you can find in here. Again, if you wanted to, you could do that. You could flip on over to the bullish side, by the way. So if you didn't want a bearish position, but you wanted a bullish setup, let's even say you were looking for a bullish setup in TLT. Like you knew you wanted to trade bonds bullish, how can I find a great strategy in TLT? Well, rather than going through the option chain and picking different strikes and randomly seeing all the different metrics and trying to remember it, you just come in here to Trade Ideas, put in your information, put in your symbol that you want to trade, in this case TLT, and then it gives you a curated list of potential ideas to trade in TLT. So you might want to go through here and look at these potential trade ideas and see if any of these trade ideas meet your criteria. These would be bullish positions, like I said. So you're selling a put option at 86, and then you're buying a put option further down below at, say, 82.5 or so, and trying to enter those positions. One thing that I do inside my trade ideas is I have a filter for this one. This one's just looking at XSP positions that have higher than 50-50 probability of profit and a reward to risk of 100% or higher. These are great ideas. I did a video on this before, but typically looking for those positions that give a lot of premium and have better than 50-50 coin flip opportunities. So this one right here might be a good one. Actually looks like a pretty decent one to enter right now, which is selling the 612 call option and then buying the 616 call option in XSP, which is cash settled. And so there's no assignment risk for this position. If I got into this position around mid price, in this case, that would be about 225 or so. This metrics still hold pretty well for 225. Probability profit is higher than 50-50, which is okay, but the reward to risk is 128%, which is really good for this position. It is a bearish position for this potential market, so that's okay. I need the market to go down or trade sideways, but it might be a good trade to get into. So if you find a trade opportunity like this, and I usually set these into different types of bots, then you simply just select the bot that you're going to throw that trade into. In this case, I'll throw it into my pure play bot that I call it. This is where I find trades like this, and then just enter these trades manually if I find any trading opportunities. I'll set smart pricing to fast, and let's go ahead and try to place this trade and see if we can get into this position. So we'll do this right now. I don't even know if we're going to get into this position, but this is the process that I would go through. Is I would use trade ideas, filter through the different things that I showed you, find a trade that you like, whether it's credit or debit spread trade, and then you can place that trade. And that's what I choose to do inside of my bots, is place them into different types of bots that kind of manage positions differently for me. All right, so you can see actually the trade did fill at 225, which is great. So this is a live trade that I just got into. So I opened it today at the time I'm recording this video here. But this is a good trade. This is a good trade that I obviously would make because I made the trade. But I like these types of setups where I can go into trade ideas, let trade ideas surface the potential opportunities. I don't know if I would have always looked at the 612 to the 614. Like, you would have to play around with it. And then you would have to remember that data against all the other potential combinations. So the reason I like using this is because it helps surface ideas if I have something that I want to find, like some type of trade setup that I want to find, bullish, bearish, some type of probability or data setup, right, where there's a little bit of skew that works in my favor. So this is a good trade. I'm already up $2 on the trade. That's probably just bid-ask spread kind of moving around, but we can move this position. You keep this position in this bot, which will manage this position if I want to. I can set my exit options on this one. So if I wanted to take the trade off at, say, 50% of the credit, I could do that. And because it's XSP, I can let it run to expiration. So it's a very easy way to kind of automatically manage the position just by quickly setting exit options. Again, I'm doing this manually. I can go in and adjust these exit options anytime I want. But now it's watching the position, and if it ever gets to 50% of the initial credit, then it will try to take the position off. But I hope this video has been very helpful to understand not only debit spreads versus credit spreads and what they are and what the differences are, but hopefully just walking through many, many examples of how you can find ideas and how you can set up these trades. Like I said at the beginning, these things are kind of the building blocks of trading spreads and options trades. And sometimes it gets confusing with the terminology, but don't let that get you down. Make sure that you understand what the setup is, if you're net buying, net selling options, and if you're a bullish or bearish position that you're getting into. Those are really the key ingredients for understanding these differences. So hopefully you've enjoyed this video. If you have any questions, as always, let us know. And until next time, happy trading.